Welcome to the deep dive. Today we're plunging headfirst into a world that's, well, fascinating, and frankly, often misunderstood: cryptocurrency day trading.
Absolutely. A lot going on there.
Yeah, but we're not just talking broadly. Our mission for you, our listener, is really specific today. We're doing a deep dive into navigating the currents, the tricky myths of short-term crypto trading when you're using only a cash account.
Right. No margin, no leverage, just your own settled cash.
Exactly. We're pulling our insights from a really excellent practical guide for individual investors, sort of boiling down the absolute essentials.
Distilling it down.
Yeah. And get ready because we've got some, frankly, surprising facts coming up, especially around those costs you don't always see,
Right.
what instant really means in crypto, and how timing becomes like your most critical asset.
It really is. What's fascinating here is how many people jump into crypto thinking it's just this wild west of easy money, quick gains.
Totally.
There's this myth, because it's digital, everything's frictionless, instant, maybe even free.
Yeah, if only.
Exactly. So this deep dive is about stripping away those assumptions, giving you the understanding of the actual mechanics you need. We're aiming for those real aha moments, especially untangling the stuff specific to cash accounts.
Okay.
It's less about just, blindly chasing charts and more about informed strategic action.
Informed action. Love that. So let's kick things off right at the beginning. When we say day trading in crypto, what are we actually talking about? It's got to be more than just buying and selling.
Oh, absolutely. At its core, day trading is buying and selling a crypto asset within the same day, often multiple times even.
Okay.
The goal isn't, long-term holding. It's not like buying Bitcoin and forgetting about it for 5 years.
Right, not investing in the traditional sense.
Exactly. It's a sprint. It's focused on capturing those really short-term price movements, sometimes tiny fractions of a percent. You're trying to capitalize on immediate market swings, sometimes over just minutes or even seconds. It's a totally different game, different mindset.
And what's really interesting, I think, is how the actual settlement in crypto makes this rapid-fire trading possible in a way that's just completely different from stocks. It's not a small difference, is it?
Not at all. If we connect this to the bigger picture,
Mm-hmm.
this whole short-term, high-frequency thing is almost uniquely enabled by crypto's near-instant settlement.
Yeah.
Think about, like, traditional stocks.
Mm-hmm.
They usually work under what's called T+1 settlement. Your trade doesn't fully settle, your funds aren't fully available until the next business day.
Right, so if I sell stock Monday, I can't use that cash till Tuesday.
Exactly. That delay just fundamentally limits how fast you can reuse your capital, puts the brakes on things.
But in crypto, that delay pretty much disappears.
Here's where it gets really interesting, I think. Once you sell on a big exchange, the money is just there,
Mm-hmm.
ready for the next trade almost instantly. That's generally the case on centralized exchanges, yes. The funds are credited internally, almost immediately. It's this speed that allows for those rapid, repeated buy-sell cycles. It makes true day trading way more feasible, more fluid than it ever was in stocks unless you had, complex margin accounts.
It sounds like a superpower, honestly.
It kind of is. But like all superpowers, right, it comes with responsibility and a potential downside.
Okay.
While the speed is a huge advantage, you can execute strategies fast, redeploy capital quickly. It also means mistakes happen just as fast.
Ah, good point.
There's less of that built-in cooling off period you get with slower settlements. If you make a bad call or the market shifts hard against you, the impact is immediate. It really demands incredible discipline, sharp decisions, and really understanding your strategy inside out. You're not just trading the market, you're trading against the clock.
And that brings us right to the core of today's deep dive. Day trading with a cash account. We're focusing here because, well, it's a path a lot of individuals choose, often for good reasons. So unpack that for us. What does trading crypto with a cash account actually mean in practice?
Okay, simplest terms. A cash account means your trades are funded only by settled cash. This is absolutely key. No margin, no borrowing from the exchange, no leverage.
Right.
You are literally only trading with money you fully own and have already deposited, and that is cleared. It's a, let's say, conservative, self-funded way to trade.
Okay.
You're not magnifying your potential gains with borrowed money, but crucially, you're also not magnifying your potential losses. It drastically cuts down your financial risk exposure. You can only lose what you actually put in.
And for a lot of people, that's the main appeal, right? Especially thinking about like rules in traditional stock markets. This is where the cash account really stands out in crypto.
It really does. One of the biggest pros, and this often surprises stock traders coming over, is that with a crypto cash account, You are not subject to the pattern day trader rule, the PDT rule.
Ah, yeah, the PDT rule. Explain that quickly.
Sure. So in traditional U.S. stock markets, if you have a margin account and you make 4 or more day trades within 5 business days, and those trades make up a certain percentage of your activity, you get flagged as a pattern day trader.
Right, and then you need that big account balance.
Exactly. You have to maintain a minimum account balance of $25,000, which is a huge barrier for a lot of smaller individual investors. It basically locks many people out of active day trading in stocks.
But in crypto cash accounts, that rule just isn't there.
That's right. Doesn't apply. The absence of the PDT rule is seen as a massive freedom. You can make as many day trades as you want, no matter your account size. 50 trades a day with $500. Technically, yes, you can.
Wow, okay, that is a big difference. But you mentioned a caveat.
Ah, yes, the crucial caveat. This freedom comes with a very important, often overlooked string attached. Specific withdrawal limitations based on how you funded your account.
Okay.
And this sets up a really key theme for us today. What looks instant on the surface, instant trading, doesn't always mean instant full access or instant withdrawal. Getting this wrong can be a major headache for new traders.
That caveat, that's huge. It leads us right into the nitty-gritty of actually doing these trades. If crypto trading is instant, how instant is instant, really? When you hit buy or sell, what's happening? How long does it take?
Right, so when we talk instant execution for this kind of rapid day trading, we're mostly talking about centralized exchanges, CEXs. Think Binance, Kraken, Coinbase.
The big names.
Exactly. These platforms allow near instant buy and sell orders once your funds are settled within their system. This is important. When you trade on a CEX, you're not usually hitting the public blockchain for every single tiny trade.
Oh, okay. Why not?
Too slow and way too expensive for high-frequency stuff. Imagine paying a network fee for every single microtrade. Instead, the exchange keeps an internal ledger, like a super-fast spreadsheet tracking who owns what inside their walls.
Got it.
Your orders get matched within that system. That's what makes it feel near instant. It bypasses the slower, sometimes costly process of recording every little thing on the main blockchain.
Which would involve gas fees and waiting for confirmations.
Exactly. It's a trade-off for speed and efficiency. But, the flip side is you're trusting the exchange with your assets. It's not quite the same as trading directly on a decentralized exchange at DEX.
Okay, so the experience on a big CEX feels immediate, and our source actually puts a number on this. A full buy-sell cycle hitting buy, then hitting sell, funds back, ready to go again, can take anywhere from, 3 seconds up to maybe 30 seconds.
That's a reasonable range.
So for a day trader, why is that specific time frame, 3 to 30 seconds, so critical? What does that mean in practice?
That time frame is, it's absolutely crucial. It basically dictates the rhythm, the maximum speed limit of your trading strategy. If you're scalping, trying to grab tiny profits over dozens of trades, every second literally counts.
Right.
A 3-second cycle gives you way more shots on goal than a 30-second one, especially when things are moving fast. The things that influence this timing are mainly 3 things.
Okay.
1, platform speed. Just how fast is the exchange's internal engine at matching orders? Some are just quicker than others.
Makes sense.
2, liquidity. How much buying and selling is happening for that specific coin? If you're trading Bitcoin, tons of liquidity, your order usually fills instantly.
Yeah.
Trading some small, obscure altcoin.
It might take longer, or you get a bad price.
Exactly. Your order might sit there longer, or you experience slippage getting a worse price than you expected because there wasn't enough volume right there to fill you instantly.
Okay, slippage. Got it. And number 3.
Number 3 is network congestion. Now, this is less about the internal trade speed on the CEX and more about getting funds in or out of the exchange. If the underlying blockchain, like Ethereum, is clogged, depositing or withdrawing can take longer, even if trading inside is fast.
Ah, okay. So the whole cycle, getting money ready to trade, doing the trade, getting money out if needed.
Precisely. For a day trader, understanding these variables means knowing instant isn't fixed. It fluctuates. And those fluctuations can mess with your entry or exit price, eating into those tiny profit margins. It adds another layer of dynamic risk you constantly have to factor in.
That distinction between the internal instant trade and the whole variable cycle time is key. But here's where it gets, I think, really vital for our listener and where people get tripped up. Funding methods. How you get the money in has a massive impact on not just trading, but withdrawing or using it again later. This seems like a huge source of confusion. Can you break down the different ways to fund an account and what they actually mean?
Absolutely. The source material lays this out clearly, and honestly, this might be one of the most critical things for a cash account day trader to grasp right from the start. Let's go through them.
Okay.
First, the gold standard for active traders. Preloaded USD. This means you sent dollars to the exchange and they've fully settled. Cleared your bank, cleared the exchange, sitting there ready.
Okay. Fully settled.
With that, you have instant full access.
Huh?
Buy, sell, and crucially, immediately withdraw those funds or the crypto you bought. No restrictions. That's your ideal setup for max flexibility, rapid moves, truly liquid.
Got it. Gold standard. What's next?
Next, and this is where the friction often comes in, ACH transfers from your bank. Super common, convenient, right? But there's a big catch.
Oh.
Your funds might show up in your exchange account almost instantly. You might even get instant buying power to trade right away.
Sounds good so far.
But the actual fiat money usually takes 3 to 5 business days to really clear from your bank to the exchange. Here's the pitfall. If you buy crypto with those technically unsettled funds, that instant credit, and then try to sell it or withdraw it before the original ACH deposit fully clears,
Let me guess.
blocked. Bingo. The platform will put temporary restrictions on withdrawals and maybe even further trades with those specific funds. Imagine, you ACH money, buy BTC with the instant credit, BTC pops, you sell for a quick profit, and you can't touch that profit.
Oh, that would be infuriating.
Incredibly frustrating. It ties up your capital, messes up your plan, sometimes for almost a week just waiting for that initial deposit to officially settle. Big trap.
Okay, so ACH is convenient, but slow to fully settle, restricting withdrawals. What about cards?
Right. Credit debit card purchases also seem instant for buying. Swipe the card, crypto appears fast. But similar issue. The platform may block withdrawal or resale temporarily.
Broad.
Usually, yeah. Fraud prevention, chargeback risk mitigation for the exchange. So you might instantly buy ETH with your Visa, see it there, but try to sell it 5 minutes later, send it to your private wallet. You can find it locked, sometimes for days, maybe even a week.
Again, temporary, but deadly for a day trader needing speed.
Exactly. It completely derails a strategy needing quick capital turns and exits. It's like, look, don't touch yet.
Okay, so preloaded USD is best. ACH and cards have these settlement delays affecting withdrawals. What's the last one?
The last one, mainly for people already in the crypto world, is stablecoins. Things like USDT, USDC. If you already have stablecoins on the exchange, this is the fastest route for crypto-to-crypto trading.
Why is that faster?
Because there are no fiat settlement delays. No banks involved in that part. You're just trading one crypto asset for another directly on the exchange's internal system. Funds are already considered crypto on their books. It's the go-to for really active traders bouncing between different coins without needing to cash out to dollars frequently. Unparalleled speed for that kind of activity.
Wow. Okay, that's a massive aha moment right there. Instant trading does not equal instant full access or instant withdrawal. It's tiered almost, based on how the money got there. Understanding that isn't just avoiding frustration, it's fundamental capital management for a day trader. That alone could save so many headaches. Okay, so we've got the speed dialed in, we understand the funding traps, but let's be honest, you're not just trading for fun, you want to make a profit. And when you're doing tons of trades, tiny costs can become huge obstacles. So what are these hidden costs people might miss?
Yeah, it's so easy to just focus on the price chart, right? But profitability lives and dies by understanding your costs. The first thing most traders hit are trading fees, often based on a maker-taker model.
Maker-taker. Break that down simply.
Sure. A maker order adds liquidity. Think of a limit order you place that doesn't fill instantly. It sits on the order book waiting. You're making the market. A taker order removes liquidity. Usually a market order that fills immediately by taking an existing order off the book. You're taking it from the market. Exchanges often give makers lower fees because they help create a better market for everyone.
Got it. And these fees vary.
Oh, yeah. Let's look at some examples from our sources because these percentages add up fast. On Binance, it's often around 0.10% for both maker and taker. Pretty low, good for frequent trading.
Okay, 0.1%.
Coinbase, advanced their pro platform, might start higher by default. Maybe 0.40% for makers, 0.60% for takers. These can drop with high volume, but for a typical individual, that's the starting point often.
Whoa, that's a big difference from Binance, 0.6% taker.
It can be, yeah. And Kraken Pro is often somewhere in between, maybe 0.25% maker, 0.40% taker.
Okay, so the implication for a day trader.
Huge. You need to strategically use limit orders whenever possible. Those often get you the lower maker fee. Imagine 50 trades, the difference between paying 0.1% and 0.6% each time. It's massive over the course of a day or week. Directly hits your bottom line. It seems small per trade, but it compounds like crazy.
Right. So maker-taker fees are the obvious ones. But you mentioned hidden costs. What else is lurking? The spread.
Exactly. The spread. Even if an exchange screams zero trading fees on some pairs, the spread is always there. It's the difference between the highest buy price, the bid, and the lowest sell price, the ask.
Like at the airport currency exchange.
Perfect analogy. There's a buy rate, a sell rate, and the gap is their profit. In crypto, it's the same. The spread ensures the platform or market makers get paid for providing liquidity, for being ready to buy or sell.
And for a day trader making tiny profit
The
margins.
spread can kill you. If you buy at the ask and immediately sell at the bid, you've already lost money equal to the spread, before even paying a trading fee. It's an invisible toll on every single trade, especially wider on less liquid coins.
Okay, so fees, spread. What about gas fees? Those sound different. When do they matter?
Great question. For someone only trading inside a centralized exchange, gas fees often don't feel direct. Gas fees or network fees are mainly relevant in two spots. One, using decentralized exchanges, DEXs, like Uniswap. Two, withdrawing crypto from a CEX to your own private wallet.
So not paid to the exchange.
Nope. Paid to the blockchain validators who process your transaction on the network itself. That's the cost of using the highway, basically.
And they vary a lot.
Hugely. Ethereum gas fees can be $5, $10, $50, even more when it's congested. Makes doing lots of small trades on Ethereum DXs really expensive, pretty much impractical for day trading tiny margins.
Yikes. $50 fee on a $100 trade. No thanks.
Exactly. Doesn't work. But other networks like Solana or Polygon, gas fees are often tiny, like less than a penny. Much better for frequent on-chain stuff if you go the DEX route.
It's a strategic choice. CEX fees and spread versus DEX gas fees and maybe higher slippage.
Precisely. You weigh the costs. CEXs usually have the trading fees and spread, but no direct gas for internal trades. DEXs need gas for everything, might have more slippage, but no CEX account needed. Depends on your style, capital, risk tolerance.
Okay, this is a lot of cost to juggle. Let's make it concrete. Walk us through that $1,000 trade example from the source. Show us how it all adds up.
Perfect. This really drives it home. Let's say you day trade $1,000 worth of ETH on Binance. We said their fee is roughly 0.10%.
Okay.
1. You buy $1,000 at ETH. Fee is 0.10%, so that's $1. You effectively get $999 worth of ETH. 2. Later you sell that ETH. Another 0.10% fee, assuming taker, another $1.02. Later you sell that ETH. 3. Now the spread. Let's say it's a modest 0.2% spread. It's about $2 on your $1,000. Not an explicit fee deducted, but it's built into the price difference. You lose $2 of value just crossing the buy-to-ask gap instantly.
Okay.
So total round-trip cost, $1 buy fee plus $1 sell fee plus $2 spread impact equals $4 total cost.
Wow. So on a $1,000 trade, it costs $4 just to get in and out. That's 0.4% of your capital gone right off the bat.
Exactly. Which means to even just break even, ETH price has to move up by at least 0.4% during the time you hold it, just to cover your costs.
That's huge. It shows why chasing tiny 0.1% or 0.2% moves is so risky. The costs eat you alive.
It's absolutely crucial. It forces the question. If your round-trip cost is 0.4%, how much does the price really need to move for you to hit your profit target? If you want a 1% profit, you actually need a 1.4% price move, assuming perfect execution.
Man.
Yeah. It hammers home why minimizing fees with limit orders, choosing liquid assets with tight spreads, and tracking costs meticulously isn't just good practice. It's essential for survival, especially with a cash account trying to compound small wins. It's a game of pennies, and those pennies add up incredibly fast.
Okay. Costs understood, speed graphed, funding traps noted. Now let's shift gears to the actual doing. How do you actually approach this? What are the core strategic things a cash account trader absolutely must keep in mind before even placing a trade?
Right, moving from mechanics to strategy. For cash account users, these foundational principles are, well, non-negotiable really. They're the bedrock.
Okay. Lay them on us.
First, and we cannot say this enough, use only settled funds. Just don't trade with money from ACH or card deposits that haven't fully cleared yet.
Because of those withdrawal holds we talked about?
Exactly. Using that instant buying power is so tempting, but it's a recipe for getting your capital locked up right when you need to be agile. It can wreck your plans. Biggest trap for new cash traders.
Got it. Settled funds only. What's next?
Second, really understand limit versus market orders. For day traders, limit orders are generally your best friend.
Why?
Control. You set your exact buy or sell price. Prevents you getting a terrible fill price in a fast-moving market, buying the top or selling the bottom accidentally. And crucially, limit orders often get you those lower maker fees.
Right, adding liquidity.
Yeah. Market orders. They execute fast, sure, but at whatever the best current price is. Less control, especially when things are jumpy, and you almost always pay the higher taker fee. Precision and cost control favor limit orders for day trading.
Okay, limit orders preferred. Number 3.
Third, volatility management. Crypto is wild.
Yeah.
Super volatile. That's the opportunity, right? Big swings mean potential profit, but it's also the biggest risk.
Double-edged sword.
Totally. Things can move against you just as fast and hard. You absolutely need risk management. Using stop-loss orders, automatically selling if the price drops to your preset level, or just watching your positions like a hawk with alerts is critical. What's fascinating here is just how quickly volatility can turn gains into losses if you're not prepared with an exit plan.
Makes sense. Need a plan B.
Fourth, asset selection. Especially when starting, stick to high liquidity assets, the big ones, Bitcoin, Ethereum.
Why high liquidity?
Because it means tighter spreads, less cost between buying and selling, and less slippage. Remember slippage, getting a worse price than intended. Happens way more with illiquid, less traded coins because there just aren't enough buyers and sellers at every price point. Stick to the majors until you really know what you're doing, minimizes those hidden transaction costs.
Good advice. Stick to BTC, ETH. And lastly,
Finally, fee tracking. Sounds obvious, but people forget. You must account for every trading fee, potential gas fee if moving funds, maybe even withdrawal fees, in every single trade's profit calculation.
don't just look at the price change.
Exactly. So many people think bought at $100, sold at $101, made $1, but forget the fees and spread might have cost them $1.50. Meticulous record keeping is essential. These costs can turn winning trades into losers without you even realizing it until later.
Okay, those are crucial ground rules. Use settled funds, prefer limit orders, manage volatility, pick liquid assets, track all fees. But beyond those rules, what are some actual strategies a cash account day trader might use? Give us some examples.
Okay, yeah, let's look at common approaches. They're all about playing those short-term moves.
Right.
One really popular, super fast-paced one is scalping. This is making tons of small trades, dozens, maybe even hundreds a day, trying to capture tiny price fluctuations.
Wait, how tiny?
Like buy BTC at $30,000, sell at $30,060. That's just a 0.2% move. Profit margin is razor thin.
Wow.
So this strategy absolutely depends on super tight spreads and the lowest possible fees. Requires insane discipline, lightning speed, constant focus, because those tiny profits get wiped out so easily by costs or a small move against you. Imagine 20 trades like that. Even a 0.1% fee each way eats up 2% of your capital just in fees.
Intense, like catching falling knives repeatedly.
Sort of, yeah.
Yeah.
Very demanding. Then there's range trading. This is more about identifying a coin that's bouncing between clear price level support, a floor, and resistance, a ceiling.
Like it's stuck in a channel.
Exactly. Maybe ETH is bouncing between $1,850 and $1,950 for a few days. The strategy is buy near the bottom, $1,850 support, sell near the top, $1,950 resistance, relies heavily on technical analysis, charting, finding those levels.
It needs patience and good chart reading.
Definitely. And
Yeah.
discipline to place limit orders at those levels. The risk, the range breaks, and you need to get out fast.
Okay. Scalping, range trading. What else?
News reaction trading, pretty much what it sounds like. Trading based on immediate market reaction to big news, economic data, crypto-specific events.
Like a country adopts Bitcoin.
Perfect example.
Yeah.
You hear the news, you quickly buy, expecting a short-term pump. Or maybe an exchange lists a new coin. Speed is everything here, getting the news fast, acting faster.
Risky, though. Buy the rumor, sell the news.
Very risky. Markets react weirdly sometimes. And yeah, often the initial pump fades fast as people take profits. You need to be early in, early out. You can easily get caught holding the bag.
Okay. One more.
Last one we'll cover is momentum trading. This is about identifying a coin that's already moving strongly in one direction, usually up and jumping on that trend.
Riding the wave.
Kinda, yeah. You buy as the price breaks, past recent highs, maybe on increasing volume, signaling strong buyer interest. Then you ride it until signs of weakening appear, volume drops, reversal candle patterns, breaks below a moving average, and you sell.
How's it different from just chasing a pump?
It's supposed to be more analytical. You're using technical indicators like RSI or MACD to confirm the strength and sustainability of the momentum before getting in, and to signal when to get out. Not just buying because it's green. Requires good chart skills and being ready to cut losses fast if momentum flips. ##MeV, platform playbook and navigating the risks.
Those strategies really help visualize how someone might trade. But okay, you've picked your strategy, maybe scalping, maybe momentum. Where do you actually do it? Because the platform choice seems like more than just picking a website, right? It affects fees, funding, could make or break things.
Oh, absolutely. Platform choice is a strategic decision in itself. Huge impact on your experience, especially costs and how funds work.
So give us some quick notes on the platforms mentioned in the source, Binance.us.
Yeah, Binance.us has at times offered certain pairs, often BTC/USD ETHed, with 0% trading fees. That's obviously incredibly attractive for high-frequency strategies like scalping, where fees are killer. Zero fees, big advantage if available.
Okay.
Coinbase Advanced.
Coinbase Advanced often gets points for a cleaner, maybe simpler interface. Could be good for newer traders, but as we said, its default fees for lower volumes can be higher, like that 0.40% maker, 0.60% taker. Might be less cost-effective for frequent small cash trades compared to Binance, unless you trade huge volume. Simplicity has a cost sometimes.
Got it. Kraken.
Kraken generally has a solid reputation, good security track record. Fees are often competitive, similar to Binance, especially at moderate volumes. And crucially for cash accounts, their interface is often praised for being really clear about showing your settled versus unsettled funds. That transparency helps avoid those deposit restriction traps. That clarity sounds valuable.
Right.
What about DXs, decentralized exchanges, like Uniswap?
Right, DXS. The big appeal is no account needed. You trade directly from your own crypto wallet. You keep control of your keys.
Sounds good. The downside?
Gas fees.
Yeah.
Every single swap on a DX costs gas. Can be prohibitive on Ethereum, as we discussed. Also, slippage can be higher than on big CEXs because liquidity might be lower on some pairs. So, CEX versus DX for day trading, it's a trade-off. CEX convenience, lower transaction costs, usually fees plus spread versus gas, but custodial risk. DX self-custody, but gas fees and potentially higher slippage. Most fiat to crypto day trading happens on CEXs for cost and ease.
Okay. Platform chosen, strategy honed. Now, the scary part. Risk. Even with a cash account, no leverage, there are still big dangers, right? And some specific to cash accounts.
Absolutely vital to understand the risk. It's not free money. Number one, overarching risk, volatility.
The big one.
Yeah. Crypto prices swing wildly, unpredictably. That's the opportunity, but it's also how you lose money fast if it moves against you. 10% up in an hour can become 10% down just as quickly. Needs constant attention, stop losses, pre-planned exits. The speed leaves little room for error.
Okay. Volatility. What else?
Overtrading. Even without PDT rules stopping you making too many trades, chasing tiny moves can kill you through cost.
Death by 1,000 cuts.
Pretty much. Fees add up, spread costs add up. A few bad trades based on poor timing. It accumulates fast. Even small losses on many trades can wipe out one good win. It links right back to tracking those costs religiously. Discipline is key.
Makes sense. What about risks specific to cash accounts?
The big one we keep hammering. Deposit restrictions. Cannot stress this enough. Buying with ACH or card feels instant, but you often cannot withdraw or resell immediately.
Until the fiat fully settles days later.
Exactly. It immobilizes your capital right when you need to be fast. A huge source of frustration and missed opportunities. Always check your withdrawable balance, not just your trading balance. Available to trade is not the same as available to withdraw.
Critical distinction. Okay. Anything else?
Lastly, custodial risk. When you trade on a CEX, they hold your crypto, not you.
Not your keys, not your crypto.
That's the one. While good exchanges have strong security, they're still targets. Hacks happen. Technical glitches happen. Exchanges can freeze withdrawals or worse, go bankrupt like FTX. It's the inherent risk of leaving funds on a centralized platform, a trade-off for the convenience and speed they offer for day trading. You have to be comfortable with that risk. #TechTag VOA. Essential tools for the journey.
Okay, risks acknowledged, mechanics understood. You're ready to actually try this. What tools do you practically need? To chart, track, maybe automate?
Right. Having the right toolkit makes a huge difference. It's not just nice to have. It impacts your efficiency and decision-making.
So for looking at charts, technical analysis.
The big two are usually TradingView and Coinigy. They're incredibly powerful. Advanced charts, tons of indicators, drawing tools, everything you need for deep technical analysis. Identifying trends, support resistance for range trading, momentum shifts. Essential for developing and executing those kinds of strategies. Many traders live on these platforms.
Yeah, okay. TradingView, Coinigy for charts. What about just tracking market prices, volumes?
For that, CoinMarketCap and CoinGecko are the standards. Real-time prices, market caps, trading volumes, info on almost every coin. Indispensable for finding liquid assets, researching coins, just staying aware of the overall market pulse. Quick check what's hot, what's not, what has volume.
Got it. CMC, CoinGecko for market data. How about tracking my own performance? Across different exchanges, maybe.
Yeah, that's where portfolio trackers like Delta or CoinStats come in. They connect to your exchange accounts via API, usually securely, and wallets to give you one consolidated view of all your holdings and performance. Super important for seeing your overall P&L, tracking gains, losses, especially if you use multiple platforms. Gives you that bird's eye view.
That sounds really useful. Okay, last category. Automation. Trading bots.
Right, order automation. Platforms like 3 Commas or Pionex offer tools for this. Trading bots, advanced order types, can be great for executing complex strategies, managing many trades, especially for things like scalping or range trading, where speed and emotionless execution are key. A bot can react way faster than you can click.
There's a catch for cash accounts, right?
UGE catch.
Yeah.
You absolutely must ensure these bots only use settled funds. If you connect a bot to an account with unsettled ACH card deposits and it starts trading that money, boom, you hit those withdrawal restrictions.
So the bot could trade, but then you can't withdraw the profit or move the funds.
Exactly. It creates unintended headaches, locks up capital just like doing it manually would. You have to configure these tools very carefully, making sure they only operate with capital that's truly available and settled according to the exchange's rules for cash accounts. Mismanage this, and a powerful tool becomes a liability fast. Hashtag tag outro.
Okay, wow. So what does this all really mean for you, our listener, thinking about jumping into this? Our deep dive today shows that, yeah, day trading crypto with a cash account offers unique freedom. No margin calls, no PDT rule worries like in stocks.
Big freedoms.
But that freedom demands serious discipline. A really sharp eye on the practical stuff, the mechanics, the often hidden bits. Success isn't just guessing the next pump, it's mastering the machine.
Absolutely. If we connect this to the bigger picture, your long-term success here depends less on luck and way more on navigating those spreads efficiently, tracking those fees meticulously, and really managing your cash availability, understanding those settlement times.
Yeah, knowing instant isn't always truly instant, or at least not unrestricted instant.
Exactly. It's a nuanced world.
So the core takeaways, the action points. Start small, track every fee like a hawk, and focus on those high liquidity assets, BTC, ETH, to minimize costs and get better execution. Knowledge really is your edge here.
It truly is. And maybe here's a final thought, something provocative to chew on. In this world of faster and faster digital everything, instant transactions, the real challenge for the cash account crypto day trader isn't just predicting price, it's mastering these unseen currents of cost and access. So how might understanding these hidden mechanics in crypto change how you look at other instant financial opportunities? Or maybe even how you think about speed and access in other parts of your financial life?
Whoa, that's a great question to ponder. As always, we really hope this deep dive serves as a solid, super useful starting point for your own informed exploration into crypto day trading with a cash account. Stay curious, stay informed, and we'll catch you on the next deep dive.